Microsoft is the only stock that was in the top 10 market cap in 2000 that's in the top 10 market cap today. Every other stock from 2000 that was in the top 10 is not there today. So what does that mean about the future of Microsoft? Well, not really much. All we care about as a channel is assessing a company and trying to make assessments about the future and make assumptions about what the future looks like to see how the company will do. Microsoft has been on a tear since this year started, along with 6 other companies in the S&P. So the question is, are you missing the boat? Now remember what we do on this channel. Our goal as value investors is to assess a company. We look at every investment as the present value of all future cash flow. And when you buy a stock, you're buying a piece of a business. So when you buy Microsoft stock, you're not buying a ticker that goes up and down. You're buying a piece of Microsoft's business. You're buying a piece of their cash flow for the future. So in this video, we're going to go over some bull cases, some bear cases. We're going to go over our most important aspect of our website, the stock analyzer tool, which allows us to make assessments about the company, assumptions about the future, and determine what price to pay today for that. Now, you have to remember, we're going to go over a lot of things here. Some are for beginners, some are for more advanced, but we have things wide-ranging, so watch the entire video so you can get a full feel. Even if you're not an advanced investor, it'll still get you in the mindset of thinking like an advanced investor over time. So let's go check out Microsoft now in our software. Guys, Wednesday, June 28th, 1 p.m. Eastern Time, free webinar on real estate. Our channel loves real estate. We just haven't made many videos on it. We're trying to restart that now. We have a great real estate calculator on our software. Free webinar. Sign up at the link below. Super easy. You're going to love it. Thanks very much. Don't forget to sign up. So look at this year to date, guys. Up 45% year to date. 45% year to date. That's incredible. In the last 5 years, it's up 243%. In the last 10 years, 900%. That is 10 times your money in the last 10 years. Okay, that's big. So a couple of things that have driven this. AI has been a big driver. They are claiming that AI will add $10 billion in revenue to the company, which is a lot of money, $10 billion. But they do $207 billion in revenue in the last 12 months. So it's about a 5% increase in revenue. Don't get me wrong. That's still a big number, but I want to keep that in perspective for Microsoft as a whole, okay? Now, in the last 12 months, they made $70 billion on that. So the question is, how much margin will be on that $10 billion? Is it going to be majority margin? I mean, Microsoft as a company has what's called a 68% gross margin. What does that mean? Well, if you see right here, gross margin, 68%. What that means is for every extra dollar they sell, about 68 cents of it can go then to pay their fixed overhead and their income taxes. That's a big number, 68%. As an example, a company like Tesla is around 15 to 20%. Software companies have very, very high gross margins because once you make the software, what are your costs to distribute that software? Very little, especially for a company like Microsoft, which has Office 365 on the computer, right? So that's one big news article about Microsoft. Another big one has to do with AI. Microsoft has also partnered with CoreWeave. This is supposed to put a dent into AWS, which is Amazon's cloud computing, and Google's cloud computing, and help them with the AI space. Guys, AI is everywhere right now. Everyone's jumping on AI. If you Google search how many times a company mentions AI in their quarterly report, quarterly earnings summary, it's absurd. So AI is the big hype right now, just like internet was the big hype 20 years ago, real estate was the big hype 13 years ago, cannabis was the hype 5 years ago, electric vehicles were the hype 2 or 3 years ago. There's always a new hype. But you got to remember, the vast majority will not do well in this new hype. So just keep that in mind going forward. So let's look at some high-level numbers on Microsoft. $2.6 trillion company. Okay, that's if you bought all the shares outstanding, and the enterprise value is 2.66. Enterprise value assumes you get all of the cash and the debt on the company. So the difference between these two is the debt. That's a very low difference compared to its overall market cap and revenue net income. Their current PE, 37. Their 5-year PE is 46. Now, guys, what does PE in and of itself mean? It means the price to earnings ratio. The price of the company, which is the market cap, divided by the last 12 months income for the TTM PE. And the 5-year takes the average of the last 5 years profit and divides it by the current market cap. okay? The higher the PE, the more expensive the company can appear. But remember, if a company has a lot of growth potential and on top of that, a high return on invested capital, and this is high, the market average is 9 or 10%. Microsoft in the last 5 years has done 24.5%. This means they get a really good return on the money that they reinvest into the business. That's a big, big number. Every value investor out there loves looking at this number. So with a high return on invested capital and a potentially high growth rate, you should pay a premium for Microsoft. But the question becomes, how much of a premium? It's easy to say, this is a great company, I should pay a high price. Well, again, if you view investments as the present value of all the future cash flow you will receive, you will realize that at some point, there is a price that's too high for that cash flow. And when it comes to companies and stocks, when they grow so fast, so quickly, you might have FOMO, fear of missing out. You might sit there and see this quick rise and go, oh, I can't lose out on this one. The successful investors are the ones that say no, or analyze the deal and say, hey, that might be too high of a price. So is Microsoft at 346 too high? I don't know. I have no idea. Let's go over a couple of bull and bear cases for Microsoft. So in Q1 2023, Microsoft held 23% of the worldwide market share for cloud computing. Amazon was number one. They were number two. Amazon was number one at 32%. That's big stuff, guys. That's really big. It's a very high margin business. Another one. For the first time ever, Microsoft Azure cloud customer adoption rate surpassed AWS. That's very big. So there, it's 77%, AWS is 76%, neck and neck, but it's the first time in the last 10 or 12 years of cloud computing becoming so important that Microsoft has surpassed Amazon for this, okay? Big cases. Now, two bear cases. Microsoft 365 has experienced outages and breaches in the system, causing tens of thousands of customers to experience issue accessing their data. Guys, for a company like Microsoft, it's all about trust. That's why you go with Microsoft. That's why you go with Microsoft. Now, to me, this bear case is the fact we're talking about a short-term bear case. Something tells me it's going to be something that Microsoft could easily fix. They have the resources to go out there and fix those problems. But data breaching is very, very important for the reputation of a company. So it's not to be overlooked, but it's tens of thousands of customers relative to probably tens of millions they have. Second bear case, the Activision Blizzard U.S. judge has blocked that. The Activision Blizzard acquisition. Okay, they have Xbox, and they've said that Microsoft isn't going to make games for the Xbox anymore. I believe this Activision deal was their way of saying, listen, we're going to put it on another company that we own. I don't know exactly if that's true or not, but the judge blocking that, I was kind of surprised by that, to be honest with you. I was like, whoa, the judge blocked it. So the judge has blocked that. It's going to go to court at some point and be figured out. So Microsoft has also announced, I believe, in 2021, they announced a $60 billion share repurchase. Now, guys, let's take a look at our 8 pillars because I want to show what's going on here. Remember, if you have our software, you can customize your pillars up to 12 pillars. And it'll pop up above here. Of course, I love the pillars because I made them. But right here, we have 2 big X's. It's our valuation metrics. So the 5-year PE, we want it less than 22.5. It's 46.3. And the 5-year price of free cash flow is 51. Now, buying back these shares, it's a check here. But I want everybody to remember something very important. Buying back expensive shares is not a good thing. Everybody gets excited about buying back shares. You should not. You should only get excited about buying back cheap shares. Because when they take their cash and they buy back expensive shares, even though it's their own, it's no different than buying the stock of another company that's very expensive. They're not doing you a service as an investor. So I don't like seeing this. Yes, it's not a big number. I get that. 60 billion on 2.6 trillion in value is not a big number. But the point is, this tells me, wait a second, what do they view capital allocation as? A good CEO is one that can very effectively allocate capital that the business generates. And as a company grows larger and larger, they have less and less reinvestment opportunity. So what they do with their cash that's sitting on their books is very important. Remember, a company can do 5 things with their cash. Buy back shares, pay a dividend, which Microsoft does at about 0.8%, pay down debt, make acquisitions, which they want to do with Activision Blizzard, and reinvest back in themselves, hiring developers, increase their R&D, etc. So those are the 5 things they can do with their cash. When they're buying back expensive shares, I look at it and say, did you really think that was the best use out of all 5 of those uses? Instead of buying back expensive shares, I'd rather give a dividend. However, here's the issue with issuing a dividend. If you issue a dividend and take it away, people hate that. If you go look at the dividend community on Twitter, they're always talking about, look at this company, they've never decreased their dividend, they've increased it 10 years in a row. But they have to look at it the right way, which is this the best use of capital? So that's something to consider here. Now, other things to look at here, very solid profit margin. The 1 year is 33%, the 5 year is 34%. So very, very close to each other. Very consistent, right? All right, let's see what analysts say. So we have our analysts on our website. Analysts expect earnings per to grow from $9.50 per share this year to $21.48 in the year ending in 2028, June 2028. Those are big jumps. Look at that. That's driven a lot by their high return on invested capital. Okay? Let's look at their revenue growth potential. Still big, from 212 to 380. That's big numbers. Now, guys, remember, these are analysts saying this. I got to take this with a grain of salt because analysts have the same career risks that anybody out there has. So they're going to want to be around each other. But I'm going to use this in our stock analyzer tool because the big thing for our stock analyzer tool, which we're going to do now, is you're making assumptions about the future. And those assumptions will drive to you what the cash flow is going to be on the business. And depending on your desired return, which is our last entry, it'll spit out the number you should pay. So if you've liked what I've shown you so far, including all the tools here for our software and our community, this is the big part of our software. Thousands and thousands of like-minded investors talking every single day about stocks, about investments, about real estate, about even crypto, even though I'm not a fan of it. We have those chats in there, and you can sign up for this. $7 for 7 days at everythingmoney.com. Very simple. $7, 7 days, $1 per day. This will change everything you do in finance. It'll change the way you think. And the most important part, like I said, being an investor can be a very lonely road. This community puts you in touch with thousands of people who will think like you. They won't agree with you. There's a lot of people in there who don't agree with me. I get a lot of pushback in the things I say, but it's a good way to start to generate your ideas and generate your process. So let's use our stock analyzer tool. I'm going to do a 10-year analysis. You can do 1 to 20. I'm going to do 10-year. And I'm going to put my assumptions here about the future, about revenue growth, profit margin, et cetera, all the way down. Now I'm going to go with low, middle, and high. The high one will be something that I feel might be in reach, but very difficult to hit. And my low will be something where I'm like, listen, if they don't hit this, then burn them to the ground. So let me put some assumptions here. Revenue growth. I'm going to go with 4, 7, and 10% revenue growth for the next 10 years. Actually, you know what? I'm going to do 5, 8, and 11. Let's do that. Profit margin. Very consistent in the last 5 years, but if you saw 10 years ago, the last 10 years, they've done 29%. In the last 5 years, they've done 33%. So our margin's increasing, probably. So I'm going to sit here and focus on increased margin. I'm going to go 29, 32, and 35%. Now look at that free cash flow. I don't like the fact it's still pretty close, but the free cash flow has decreased in the last 5 years. Okay, I don't know. So for this one, I might do 27, 30, 33. Now for PE, guys, the current PE on Microsoft is 37. The current price of free cash flow is 45. I would put this on here because everybody asked for it. But what you should do is say, okay, if the market average for PE and price of free cash flow is 15 or 16 over long periods of time, not today, over long periods of time, what should I pay as a multiple for this company? Well, it's got a great brand, got a great moat. It generates a high return on invested capital, and it's got a decent growth potential. So you have to sit there and factor those things in. This is the art of investing. There's no right or wrong answer. There are just high assumptions and low assumptions. So I think to myself, 15, 18, and 21. Because Because I think if they are able to get this 11% growth rate and these margins, that justifies them getting a much higher multiple than somebody else. And this multiple is for, hey, if you want to sell this company in 10 years, what multiple would you sell it at? Now, finally, for my desired annual return, guys, remember, as you make higher assumptions, you need more margin of safety. This is where you put your margin of safety in. The higher the return you want, the lower the price you pay. This cell phone is $1,000. Let's say it's worth $1,000. If you pay $100 versus $900, which one has a higher return? The $100 investment. The lower price you pay, the higher return. Same thing here. Now, I've already made some pretty low assumptions here, so I don't need as much margin of safety. I'd probably be happy making the market 10% here. But as I go higher, I need a higher return. So I'm going to do 10, 12, and 14%. Again, it's up to you what you put in. There's no right or wrong answer, but that's why the community is so valuable. I'll have people in here screenshotting, tagging me, tagging others, saying, hey, do these assumptions make sense? Sometimes I'm like, you know what, your assumption's a little too low. Other times I'm like, whoa, where'd you get those assumptions from? So it's a good way to engage, to talk about your way of investing. So hit the analyze button. Boom. Now, low price, 125 to 140, high price, 220 to 230, middle price of 170 to 180. It's on my watch list at 190. All I have to do is hit this plus mark. Now, the interesting part about our software now, if you paid the current price and all the low assumptions occur, you're going to make a negative 2.85% return. If you pay current price and all the middle assumptions occur, you're going to make 2.67% return over 10 years. If you get the high assumptions that happen and you pay the current price, 8%. So the best things have to happen of my assumptions here, and I still only make 8% if all those assumptions occur. Now, when looking at these prices, one of the most common things we hear is, the stock's not going to fall this much. It's not going to fall 50, 60%. Guys, twice in the last 20 years, the stock has fallen over 60% or more, and most recently 33% in COVID. Things will happen. Look at this company here in the last, let's go back to the last 5 years. It's fallen. It will fall if the things turn, which eventually happens, just like a turn on cannabis, just like a turn on electric vehicles, just like look at Kathy Wood's investments. She was a high of 160, and now she's selling at $42 for ARK investments. These things happen. Patience is the best friend to investing. So guys, again, makes perfect sense. Everythingmoney.com, $7 for 7 days. Check it out. I appreciate your time very much.